The other question that tends to come up a lot from business owners is asking me like when am I supposed to sell? I went to Paul, I went to Franco, they told me my business is worth X, what should I do? And surprisingly, in most instances, the business owner isn't necessarily doing what they would do quantitatively if they were making a capital allocation decision in their own business. Okay, I don't know. You've probably seen this. You've probably seen this in other people's.
I see it 100%. I a million percent agree with you, but I want you to elaborate on that.
So what I mean by that is that one thing that we do for folks, and this goes back to your question on what we would do a few years in advance of meeting someone who is going to sell, is we would do what I call a sensitivity analysis and actually model their business out in the core financial metrics, so revenue, EBITDA, after-tax profits, et cetera, et cetera. That way, if they come to you and you go and say, hey, Mr. XYZ Fire Protection owner, your business is worth 15 times EBITDA, and you're doing, let's just say, $100 in EBITDA. So their business is worth $1,500, okay? So we would take that information and have a conversation about the trajectory of their business and then run a sensitivity around that, as well as a sensitivity around what multiple they could potentially expect to receive for their business. Because I think you and I would both agree, due to this flood of capital from private equity, multiples are high. They're as high as they've ever been. Right. So let's say you have that example. They do $100 in EBITDA and the business is worth $1,500. Let's just say, for example, that they grow 10% EBITDA over the next 3 years, but then lo and behold, there's no more private equity and it's worth 8 times EBITDA. Like, what does that look like for the value of your business? So run the math. 100 for 3 years, it's about $133 in EBITDA, okay? So if that goes for 8 times EBITDA, now you're talking about, what is that? 1,100, it's like 1050, something like that, 1060. So now instead of 1,500 valuation for your business, you're looking at, let's just call it 1,100. So almost a 30% decline, even though you grew your business, just because the multiple went from 15 to 8. Okay, so really understanding that quantitatively and seeing it on the page as an actual analytical quantitative decision, I think is important. Because, give you another example, let's say they don't get 15 and it doesn't go all the way down to 8, but they get 12 times, which completely reasonable.
From a historical perspective, is phenomenal.
Yeah, it could be rich.
I mean, for the last 100 years, I think the S&P 500 is probably traded below 12 for 80% of the time.
Oh yeah, you're right. Yeah, I think we're at 14 and a half, 15 times now. And that's the best companies in the world, the 500 largest companies. So let's say in this example, you went from 100 in EBITDA to 133 in EBITDA, and instead of 15 times, you got 12 times. So now for 3 more years of work, 3 more years of grind, as some would say, instead of kicking your feet up on the beach, spending time with your family, you increased your value by 6%.
I think you just convinced me to retire. That's what I think you've done.
Yeah, you
It's like, what am I doing?
Yeah, what are you doing? Yeah, sell. And so, but that analysis is important, and it's typically not something anybody ever does personally for their business, right? And they don't go and they ask hey, let me go ask my top manager to perform that analysis. Let me go ask my CFO to perform that analysis. They just don't typically do it.
You're right.
Yeah, but I do think that's critical.